Thank you, Adrian. Good afternoon, everybody. It's great to be here. Thanks for joining us this afternoon. We're going to continue our discussions of the inner circle strategies, and today we're going to focus on the dividend strategy. And our dividend strategy is fairly simple. We want to invest in companies who have a history of increasing their dividend, and then we want to compound our results by reinvesting those dividends in additional shares of stock. So I have some new material for today's webinar that I haven't presented before, so hopefully you'll learn some new insights into the dividend strategy. And of course, we have a dividend portfolio with Inner Circle, and most of the stocks that are in that portfolio are in several different categories. Most are either master limited partnerships, real estate investment trusts, energy trusts, or income funds. So that constitutes the majority of our dividend trades. And today, we're going to take a more detailed look into the real estate investment trusts and the master limited partnerships. Those two categories make up the bulk of the stocks in our dividend portfolio, and that portfolio has been performing very well. We currently have over 100% return in that portfolio. And if you noticed, over the last year or two, there's not as much volatility with the profits in this portfolio as there are with some of the other portfolios. So this is lower risk, obviously, than most of the other Inner Circle portfolios, but despite being lower risk, it's got a tremendous return. And that's mainly due to this simple strategy of investing in companies that have a history of increasing their dividend and then compounding the results. And I'll show you some examples of a recent dividend I received from Real Estate Investment Trust and an MLP, and I'll show you how I reinvested those dividends in additional shares of stock, which allows me to compound my returns. So in general, the dividend growth rate is a very reliable forecaster of future earnings growth and the general overall financial health of a company. Of course, the dividends are paid in cash, and corporate directors, they're not going to raise that dividend unless they know that the future earnings can sustain that dividend. So this is one of the most reliable fundamental indicators for a stock, and it's when a company raises its dividend, it's signaling that it's doing well and it's going to have the earnings to sustain that dividend. So that's a great indicator of a healthy company that's growing its earnings. So we like to focus on those companies in this portfolio. And let's talk about real estate investment trusts for a minute. And of course, they get a special tax treatment. Real estate investment trusts, they don't have to pay any federal income tax if the REIT distributes at least 90% of its income in the form of dividends to shareholders. And as a result, the REITs pay a much higher dividend than other dividend-paying stocks because they pay no tax. And I've noticed over the last 27 years or so that I've been investing in stocks that these real estate investment trusts almost always outperform the S&P and the general market. And I think that's in a large part due to this special tax treatment. So I've just noticed over the years, no matter what time period you look at, these REITs far outperform the S&P. So I mean that's a good sign that that they can not only produce income, but their capital gains have been higher than the S&P. So all in all, for this is a great investment if you're looking to save for your retirement, or if you just want a source of income. These stocks can provide income and capital gains. So this is a great way to diversify your portfolio. If you hold options or option spreads or riskier trades, this is a great way to diversify that by holding these dividend-paying stocks, either the real estate investment trusts or the master limited partnerships. And even though they're lower risk than your other portfolios, the returns are substantial. And we'll take a look at the current results for our dividend portfolio here in a few minutes. So there's two general categories of real estate investment trusts. There's equity REITs. Now, they own the physical property, such as retail shopping centers or apartment buildings. And then we have the mortgage real estate investment trust, which invest in mortgages. And we have both kinds of REITs in our dividend portfolio. And again, the REIT strategy is very simple. We buy REITs that have a history of raising dividends, and we reinvest those dividends in additional shares to compound our returns. And as I mentioned, over the last 27 years that I've been investing, I've done a lot of comparisons, and these REITs, no matter what time period you're looking at, they normally outperform the general market by a pretty wide margin. So what I did was I took a sampling of different types of REITs. We're going to look at mortgage REITs. We're going to look at REITs that own apartment buildings, shopping centers, discount outlets, and so I took a look at REITs in different sectors, and I compared the return of the real estate investment trust versus the S&P 500 index over the last 10 years. And so this sampling of REITs in different categories produced an average return of 817% versus 9% for the S&P over the same 10-year period. So you can see that's a pretty big outperformance by these REITs compared to the S&P. And here's a profit comparison between Tanger factory outlet centers. They own the factory outlet centers. A lot of you may have shopped at these kind of centers. But over the last 10 years, this REIT has returned 807% versus 9% for the S&P. So that's a pretty big outperformance. And here's a graph of the profit performance. This is Tanger profits here at just over 807%. And here's the S&P 500 index at 9%. So a big outperformance by this REIT versus the S&P. Here's LTC Properties. They own long-term care and assisted living properties, and they've had a 1,278% return versus 9% for the S&P. So again, another big outperformance of this REIT compared to the S&P index. This is Mid-America Apartment Communities. They own apartment complexes in the Sun Belt region of the U.S. 460% return versus 9% for the S&P. Federal Realty Trust, they own retail shopping centers, 608% return versus 9% for the S&P. And we'll look at one more. This is National Health Investors, and they finance healthcare properties through mortgages and purchase and leaseback transactions. again, a big outperformance, 933% versus 9% for the S&P. So this outperformance is reflected in our dividend portfolio, and that's why we have such a great return in this portfolio, even though it's in a much lower risk category than our other portfolios. And let's look at master limited partnerships here. And the MLPs are similar to the real estate investment trust in that they pay no tax. So again, that allows the MLPs and the REITs to pay much higher dividends than other dividend-paying stocks because they pay no tax. So there's also a second tax benefit with MLPs. When they make a distribution, it's considered a return of capital, and the IRS generally considers 80 to 90% of your MLP distribution as a return of capital, which means you can defer taxes on those gains for years and years and years until you actually sell the units. So there's an added benefit with MLPs, and the MLP industry was created, I believe it was 1987. There was a special law passed by Congress for special treatment by the IRS of MLPs. And due to this special tax treatment, it's attracted a lot of companies in a variety of industries, such as oil and gas exploration, coal mining, energy pipelines, timber, fertilizers, and real estate. And just like the REITs, these MLPs, they're able to sidestep the IRS and pass their earnings directly to their shareholders. So that's why these, I think, these two categories of dividend-paying stocks have performed so well. And just like the REIT strategy, the MLP strategy is pretty simple. We buy MLPs that have a history of raising their dividends, and then we reinvest those dividends in additional shares to compound the returns. So again, if they're raising their distribution or their dividend, that's a clear sign that the company is doing well and that they believe they're going to have the future earnings to sustain that dividend increase. So a great fundamental indicator. And I just wanted to look at one MLP I've owned for a long time, Kinder Morgan Partners, and they have a long history of consistently raising their distributions. And if you had invested $25,000 in Kinder Morgan 15 years ago, that $25,000 investment would have spun off over $169,000 in distributions. So that's $169,000 cash distribution based on a $25,000 investment. So it just shows you that the strategy of buying these companies that have a history of raising their dividends can produce great returns. So again, this is strictly a cash-on-cash return, and it doesn't account for any increases in the price of the Kinder Morgan stock, and it doesn't include compounding our returns. So this cash distribution would have been much higher if we were reinvesting these dividends over that 15-year period. It'd be considerably higher. But just looking at a simple $25,000 investment 15 years ago, you would have received over $169,000 in cash distributions. And here's a graph of the total return for Kinder Morgan, and it's had a total return since its inception in 1992 of over 5,000%. Great returns for such a low risk investment. Kinder Morgan is one of the pipeline MLPs, and they simply transport energy and store energy, and the price of the stock is not that dependent on the price of crude oil, because they're simply a toll road in the energy complex, and they simply transport the energy and store it. So their price isn't that sensitive to the price of a barrel of crude oil, and as a result, they've been able to consistently raise their dividends and produce a great return. And you can see even during the last severe bear market, the price of Kinder Morgan did go down, but not as much as the average stock, which went down anywhere from 50 to 60% during this bear market. So even though there's less volatility with these types of stocks, and they produce great returns, the risk is considerably lower than owning other types of stocks. And what I did was I took a sampling of MLPs in different types of industries, and just like the real estate investment trust, I compared the return of the MLP versus the S&P over the last 10 years. And this first example is for New England Realty MLP, and they had a 462% return versus 9% for the S&P. And this sampling of MLPs on average had a 1,232% return versus 9% for the S&P. So again, a big outperformance for this sampling of MLPs in different industries. Here's a profit graph for Alliance Resource. That's a coal mining company. They've had a 1,274% return versus 9% for the S&P. And here's Terra Nitrogen. That's a fertilizer company, 3,355% return versus 9% for the S&P. Magellan Midstream, 665% return versus 9% for the S&P. And Magellan is a midstream pipeline company, energy pipeline and storage company. And here's one more. This is Capano Energy, 407% return versus 9%. And Capano is an oil drilling and exploration company. Now, I also wanted to mention that there's ETFs for MLPs, such as the Illyrian MLP Index and the Illyrian MLP Infrastructure Index, and they hold baskets of MLP stocks in their portfolios. So this is a convenient way to participate in the income and the profit potential, the capital gains potential of the portfolio of these MLPs by just simply owning a single stock. And I own the Illyrian MLP Infrastructure Index ETF, and the symbol on that is MLPL. And I took a snapshot of my profit loss report the other day for this MLP ETF, and I had a $30,000 open trade profit in the in this MLP ETF, and that's a MLP infrastructure ETF. And I have this set up for automatic reinvesting of the dividends in additional shares of stock, and that they're referred to as a DRIP program, dividend reinvestment program. And you can set that up with your broker, and then when you receive a dividend, it's just automatically reinvested in additional shares of stock or with no brokerage fee involved. And just recently I got a 4,796 dividend for my shares of MLPL, and it was automatically reinvested in 114.2 shares of the stock. So every quarter these dividends get reinvested, and just recently I purchased an additional 114 shares. So that allows me to compound my returns, and we'll look at an example of how the compounding can really boost your return over time. Again, we can compound our returns by simply reinvesting our cash dividend in additional shares of stock. And let's look at another example. This is for American Capital. This is a real estate investment trust that holds mortgage securities. And this brokerage confirmation shows that I bought 4,000 shares of American Capital at $28.56. And then just recently, I received a $5,600 dividend, and that was reinvested, and I purchased an additional 191 shares of American Capital. So what I did is I did a study based on my cost basis. It cost $114,248 to purchase these 4,000 shares. That's after commission. So I did a study based on that initial investment of what the dividends would produce over a 10-year period by compounding the returns by reinvesting the cash dividends in additional shares of stock. And I found out that by reinvesting the dividends, my $114,248 investment would grow to over $774,000 at the end of 10 years. And this is assuming that the price of the stock doesn't change, and that it continues to pay a $5.60 annual dividend. And you can see after year one, by compounding the dividends, my annual yield is 21%. After 3 years, I get a $35,000 income, which works out to a 31% return. After 5 years, I get a $51,800 yield or cash dividend, and that works out to a 45% yield. So you can see that over time, reinvesting these dividends really starts to compound your returns. And that's one of the reasons why our dividend portfolio is performing so well, because we reinvest the dividends, and they help us reduce the cost basis of the stock. And so by compounding those returns, you can really start to get substantial returns after time. And in this example, with the American Capital, reinvesting the dividends, I'd get 100% return in less than 4 years, 200% return in less than 6 years. And so that's a pretty good rate of return. And here's a graph. Now these are just the dividends here. This doesn't include any change in the price of the stock or a change in the dividend. So strictly, if they continue to pay that same dividend, here's a graph of the returns and the yields. As I mentioned, after 3 years, I'd have a 31% yield. After 5 years, I'd have a 45% yield. And then after 10 years, I'd have 118% yield. Now, this is a cash-on-cash yield. So after 10 years, you got 118% yield on your investment. Here's a sample of some dividends I received recently that come out to over $56,000 in cash dividends. And again, I like to reinvest this in additional shares of stock. So let's take a look at our dividend portfolio. And as you can see, it's mostly comprised of the real estate investment trusts and the MLPs. And we currently have $169,000 in open trade profits and average return of 103%. And if you noticed, over the last year or two, when there was a lot of market volatility, this portfolio didn't tend to have the wide price swings or changes in our profit or return like some of our other portfolios did. So this is lower risk, and yet it still provides a great return. So I think this is a great addition to anybody's portfolio if they want to diversify and save for retirement or develop an income stream. So this is a great way to diversify your other types of positions or strategies. So, all right, that concludes my presentation for today. So I'll be glad to take any questions that you may have.
Chuck, you have a few questions in the chat area or in the Q&A section. I made sure that I replicated both of those in between each area.
Okay. Okay. All right, great. Yeah. Okay. Here's a question. Stock and option selection involve technical and fundamental analysis. I have seen Chuck's technical analysis, the 50, 100-day EMA, OBV, 52-week high, etc. When will Chuck discuss the fundamental side of stock and option selection? And I believe in our last webinar, we did go into the fundamental indicators I like to use, which are the growth in equity, the growth in retained earnings, and the sales growth or the revenue growth. So we did look at those fundamental indicators in our previous webinar, and we'll be looking at those again because the stock market has really changed this year compared to the last several years, when the last several years there was very little trend, a lot of price swings, a lot of volatility. And if a company reported great earnings last year, and it just so happened that day the S&P was down or the Dow was down 300 points, it really didn't matter if the company had great earnings. It would probably go down in step with the S&P because stocks traded more like a commodity. But now this fundamental analysis works again, and you can get a real edge by using this fundamental analysis to select stocks or sectors of the market and outperform the market as a whole by using this fundamental analysis. So we'll be devoting more webinars in the future on this fundamental analysis because it can give you a real edge this year. This year, the markets look more like they did in the 1980s and 1990s when there was a great trend and you got a great return, and almost all sectors were going up in lockstep. So this is the market overall this year looks very good compared to the last several years where there was virtually no trend and just a lot of volatility, and you gave back a lot of your profits with the wide price swings. Okay, are there any other types of stops that Chuck uses other than the mental and closing stops for capital preservation. No, I don't. I don't use any other types of stops because if you use a stop and there is a wide price swing during the day, then you could easily get stopped out of your position, and then the stock comes right back to where it started, and you got stopped out like a lot of other people. So in general, I don't like to use stops. I use a mental stop, and if the stock closes 10 to 15% below our purchase price, then we'll simply exit, and you'll get an email with the exit signal. So I don't like to use stops, period, because so many people have got stopped out in the last couple of years only to see the stock come back and start rising again. And if they didn't have the stop in, they wouldn't have been stopped out. So I think it's bad money management to use a stop. Okay, here's a question. How does Chuck find these dividend stocks? And what I do is I will go on to Yahoo Finance or Google Finance, and I'll look at that industry. Let's say it's the MLPs. I'll look at the stocks in that industry, and then I'll focus on those stocks, and I'll take a look at their dividend increases and see which ones have consistently raised their dividends. And those are the stocks I think have the best profit potential for this particular strategy, and we'll focus on those stocks that have been consistently raising their dividends. So that's how I select the dividend stocks. I'll look at the stocks that are in that industry and examine each one for the ones that have and try to pick out the ones that have the best profit potential. Okay, is there an ETF you recommend for real estate investment trusts? And there are several really good real estate investment trust ETFs. One that comes to mind is the IYR, and just like the MLP ETFs that I just showed you, the real estate investment trust ETFs would basically perform the same function. In other words, it would allow you to buy these a basket of REITs with one stock. So that would be a convenient way to invest in REITs. Okay. Here's one from George, a question from George. Is there any reason to not put these dividend vehicles in Roth IRAs? And George, I'll ask you to talk to your tax advisor about that. I'm not a tax advisor. I don't know all the ramifications of a Roth IRA, so I can't comment on that, but I'm sure that you could find out what the tax consequences are for, let's say, an MLP in a Roth IRA. But I'm simply not familiar with Roth IRAs, so I think you'd be better off just to talk to your tax advisor. Okay, here's a question. Most of the dividend portfolio has been held for a while. For new members, which of these holdings would be preferred to enter now? And in the Getting Started video, what I recommended was that you pick out 5 stocks in any given portfolio that are in different industries, and that way you can diversify your portfolio along 5 stocks. So in the case of the dividend portfolio, I would pick 5 stocks that are in different categories, maybe a mortgage real estate investment trust, maybe an equity real estate investment trust, maybe an oil and gas pipeline, maybe a fertilizer MLP. So I would mix it up in buy 5 stocks in different industries for diversification. And that's a way that you could get started right away in the dividend portfolio by picking out 5 stocks in different industries. Here's another question. Would you sell portfolios of these holdings at profit levels like the stock portfolio? And no, this would fall into a different category than our stocks, because the stocks we're looking for strictly for capital gains. So the stock portfolio will be much more volatile, and there'll be a lot more price swings in the stocks than there is in the dividend portfolio. So that's why we look to take profits on the stock portfolio because of the volatility, and we're looking strictly for capital gains. But the dividend portfolio is a little different. That performs best over time. So we want to hold those dividend-paying stocks and compound the dividends. We're not looking for capital gains with the dividend portfolio. We're looking to compound our returns by reinvesting the dividends in additional shares. So that's a totally different money management concept than capital gains in a stock portfolio. Here's a question. What is your opinion of EOD, GGN, CHY type of holdings for income and drip systems? I'm sorry, I'm not familiar with GGN or CHY. Can you tell us anything about mutual holding company MLVF, what we can expect? I believe that's Malvern Federal, if I'm not mistaken. And with the mutual holding companies, there's no way to predict which one of those are going to do a second step conversion. So we simply try to hold as many as we can. And then you want to actually own the stock before they make that announcement, because once they make that announcement, the stock usually has a pop the next day, and if you don't own it, then you're going to miss out on a big part of the appreciation from the second step conversion. So the only thing you can do in that situation is just own as many of them as you can and just wait for them to announce the second step. And if you own the stock prior to that announcement, then you can get a bulk of the price appreciation. And are there any ETFs you recommend for the energy trusts? And I'm not aware of any ETFs for the energy trusts, although the way the ETFs are going, I'm sure there is one, but I'm not familiar with any. Okay, what is a good way to find 50, 100-day EMA crossovers? And the way I do it is I just simply, I have my stockcharts.com. I'll have a chart set up with the 50 and 100-day EMA, and then I'll just type in a stock symbol, and then it only takes me a few seconds to check the 50, 100-day EMA crossover for any stock. So there is no automatic way to do that. So if you set up your chart so that it's you have a template with the 50 and 100-day EMA crossover, then you simply change the stock symbol, and then it only takes a few seconds, and you can see, you can look at a lot of different stocks very quickly, but it has to be done manually. There's no automatic way to do that. Okay, with so many sectors, does Chuck try to find stocks in leading sectors? Yes, I like to look at the sector performance. I keep track of that in Yahoo Finance in the portfolio sections. I'll keep track of sectors and their percent gain for the current year and the percent gain for the previous year, or different time periods like 90 or 180 days. So I can keep track of that in Yahoo Finance in the portfolios. I also like to look at IBD on the Monday edition, they have sector rankings, so I also look at that and try to stay on top of these sectors that are performing well, because with the type of market we have this year, you can really get significant outperformance looking at sectors that are performing well relative to other sectors. Okay, here's a question: how often do you send out alerts? And that will vary depending on market conditions. And recently, now that the markets are trending better, we've had a lot more alerts for options and stocks than we had, say, over the last several months. So it all depends on the market conditions. So there's no set number of alerts that we do over a set period of time. So it all depends on market conditions. So I think that's it on the questions. I want to thank everybody for attending, and I'm looking forward to talking to all of you in our next webinar. Have a great day.